we're in the thick of earnings season now for banks. Our next guest calling Goldman's first quarter results its cleanest quarter in a while. For more on the banking sector, bringing in Barclays senior equity analyst Jason Goldberg. Jason, it's good to see you. So Goldman reports investors like what they see. The stock is up about 3% on a down day. But give us your high-level thoughts, Jason. What did you make of the results?
Yeah, no, certainly. As you said, Goldman had its cleanest quarter in a while. I think it spent much of last year kind of narrowing its ambitions in the consumer space, and that resulted in a fair amount of charges, as well as it kind of reshifted its balance sheet and built capital. And you also had very subdued investment banking activity last year. You turn to the first quarter this year, you did see a pickup in investment banking activity, albeit still below historical levels, but much improved. They posted pretty impressive trading results, particularly relative to what we saw last week out of JP Morgan and Citigroup. And we didn't have, these kind of nagging charges that weighed on results most of last year. So, here's a company that, put up a, mid-teens ROTCE after putting up kind of a single-digit ROTCE last year. So off to a good start.
So this is a very different story than the narrative around Goldman Sachs last year, right? To your point, the numbers were different, but also the sort of vibe. David Solomon was sort of getting a lot of criticism. Execution-wise, what has changed at Goldman? I mean, some of what you're talking about is just lapping bad comps, but what have they really done that you think has been the pivot here in getting to this better performance?
Yeah, no, certainly. I think, in 2001, 2002, they spent a lot of time, energy, and money kind of building out, a mass market type consumer franchise, both lending and even wealth management, and spent much of last year kind of downsizing that. So downsizing what they're doing in the credit card space, selling off their GreenSky unsecured consumer lending platform, selling off their personal financial management unit that they acquired not that long ago. And, to do that, they certainly took on some charges and costs associated with that. And finally, as you start to see the results this year, you don't have the drags from those businesses and just the cost to exit those businesses weighing on the results. And on top of that, you did see a strong trading quarter. And, finally, after, really 2 years of subdued investment banking activity, signs of life in both underwriting and M&A.
And Jason, I'm just curious to get your take on kind of the job you think CEO David Solomon has done here. I mean, to Julie's point, last year was rough. He caught a lot of heat, criticism for the consumer business. You know the firm so well, Jason. What grade would you give him?
Listen, I think they took a chance on the consumer strategy. It didn't work. They quickly pivoted away from that. So it's hard to sometimes fault management for trying strategies to grow. I think sometimes companies don't try to find enough ways to grow. I'll give them, it didn't work, and I'll give them credit for, quickly pivoting, cutting their losses, acknowledging, they try to do too much too quickly, and kind of refocusing the franchise back to the core strengths in terms of investment banking, and trading. And now with kind of a renewed emphasis of kind of merging their asset and wealth management businesses together, you're starting to see the fruits of that labor come together. And you're seeing a pickup in both, record assets under supervision this quarter, as well as kind of reducing the capital intensity of that business.
Jason, I want to broaden out, if we could, and talk about the other banks that we've heard from thus far, because I am not a TikTok user, but clearly you're more up on your TikTok trends than I, because you wrote your latest note reacting to the bank earnings, sort of a riff on no Chick-fil-A sauce, which I guess is a thing. The disappointment that investors felt in not getting that in net interest income forecast increase from a lot of the big banks. Why do you think they didn't get it? And do you think that the banks are going to kind of muddle along as a result?
Yeah, certainly that was a theme on Friday, I think, with JP Morgan, Wells Fargo in particular, and also Citi not increasing that interest income guidance, something that investors were looking for. State Street did. You fast forward to today, M&T actually did. And we still have a lot more banks to come out this week. I think a lot of it's just driven by banks taking some, a cautious approach. Loan growth is off to a slow start this year. That tends to be a big driver of net interest income. And while deposit trends year to date have been good, I think there is just some uncertainty, particularly given, at one point we thought that was going to cut 6 times this year. Now the market's thinking 2 to 3 times. And ultimately how deposits behave against this kind of changing backdrop, I think gives management a little bit of pause for not wanting to increase their net interest income guidance after, them kind of having to lower guidance throughout the course of last year, just given, some of the issues that banks had around deposit pricing.
And Jason, Morgan Stanley reports tomorrow. You're a fan, overweight the name. What do you expect to hear?
Yeah, no, certainly. I think you'll see, like you saw at some other banks, pretty strong results in investment banking fees. So you should have a pretty strong quarter there. Much more strength in fixed income underwriting. Less of an increase in equity underwriting and maybe a further decline in advisory. Although we do think pipelines are good there. They should have a sound result in trading. They're more geared to equities. Equities is kind of running up year over year, despite the fact you had tough comps a year ago. And both their wealth management and investment management businesses should benefit from the market lift. And I think importantly for them, net interest income was a headwind for them last year in the wealth management unit. We do foresee signs of stabilization in the first quarter of this year. So we think they'll put up pretty sound results.
And Jason, maybe this is a little unfair because we haven't heard from them and we're not entirely through the season yet, but what's your top pick within the space right now?
Yeah, no, I think generally speaking, certainly have a bias towards the bigger banks. We've talked about, improvement we're seeing on the capital markets front. We haven't gotten into credit quality yet. We'll hear more about that as this week goes on from some of the regionals. But while this first quarter feels okay, we do see loan losses materializing throughout the year progresses, more so in the regional banks, given their commercial real estate concentrations. So maybe a little bit more cautious there. But despite the sell-off on Friday, still feel very comfortable with names like, at JP Morgan. We're looking forward to Bank of America results, which also reports tomorrow.
And so are we. Jason Golberg, thanks a lot. Good to see you.
Thank you.